California's housing market has been on a roller coaster ride for years, but in 2025 we could be seeing a major shift in the market. In today's video, we're breaking down the top 10 California cities where housing prices will crash this year. Whether it's due to economic instability, overvalued real estate, or changing buyer demand, these cities are primed for a market downturn that could leave homeowners and investors reeling. From the Bay Area to SoCal, we're diving into the cities where you may want to hold off on buying if you don't want to lose your shirt. If you're thinking about purchasing in California, or you're wondering if the market is still worth the investment, this video is for you. Let's explore which cities are most likely to see sharp declines in home values and why they should be on your radar. Stick around till the end. You won't want to miss the #1 city that could face the biggest crash of all. Let's get started. Number 10. Fresno. In 2025, Fresno is increasingly on analysts' radar, not for growth, but for the very real risk of a housing market downturn. For years, Fresno was seen as a more affordable alternative to California's major metro areas, but while median home prices remain lower than the state average, they rose dramatically during the pandemic-era buying frenzy. Now, with interest rates still elevated and demand softening, Fresno's overheated market may be cooling fast, and values could soon start slipping. One major concern is economic vulnerability. Fresno's job market is heavily tied to agriculture and public sector work, both of which are sensitive to seasonal changes, drought, and budget constraints. Unlike coastal cities with diverse, high-paying industries, Fresno lacks the kind of economic resilience that supports long-term home value growth. With wage stagnation and inflation hitting local families hard, the gap between home prices and what residents can actually afford is widening, and that spells trouble. Another red flag is inventory buildup and slowing sales velocity. While construction has continued to expand outward into the Central Valley, buyer demand has dropped. Homes are staying on the market longer, price cuts are becoming more common, and investors are beginning to pull back. Combine that with rising utility costs, especially during Fresno's brutally hot summers, and the overall cost of home ownership is becoming harder to justify. Environmental and infrastructure challenges only add to the pressure. Fresno routinely struggles with air quality issues, drought, water restrictions, and aging public services. These problems don't just affect daily life, they directly impact the city's long-term desirability. For buyers hoping to build equity, the risks in Fresno are growing. If market corrections continue statewide, Fresno could be one of the first to feel the drop and the last to fully recover. Number 9. Palm Springs. In 2025, Palm Springs finds itself at a turning point. Once a haven for retirees, second home buyers, and short-term rental investors, this desert city is now facing signs of housing market instability. During the pandemic, prices surged as remote workers and vacationers poured in. But now, with rising interest rates, economic uncertainty, and shifting travel trends, demand is cooling fast, putting Palm Springs on the verge of a significant price correction. The city's real estate boom was largely fueled by the short-term rental market, but as more strict regulations are implemented and tourist activity fluctuates, investors are starting to exit the market. With many vacation homes sitting vacant in the off-season and monthly carrying costs rising, owners are cutting prices to attract buyers, or simply offloading properties. Oversupply and weakening demand could drive home values down sharply, especially in newer developments and high-end communities. Environmental concerns are also putting pressure on the market. Palm Springs regularly experiences triple-digit heat, and water scarcity is becoming a bigger issue each year. These climate conditions not only affect livability, they drive up energy and maintenance costs, further deterring long-term home ownership. As affordability becomes a concern even in previously desirable areas, some buyers are rethinking whether the Palm Springs lifestyle is worth the investment. In 2025, Palm Springs still looks beautiful on the surface, but beneath the sunshine lies a softening housing market. With fewer full-time residents, growing environmental challenges, and a cooling investor base, home values are increasingly at risk. Buyers and investors should tread carefully, because while Palm Springs may still be a popular weekend escape, Its days as a solid real estate bet may be fading fast. Number 8. Bakersfield. In 2025, Bakersfield may appear attractive to budget-conscious buyers due to its lower-than-average home prices, but beneath the surface, this city faces several issues that could lead to a significant housing market downturn. During the pandemic housing boom, prices in Bakersfield surged as buyers sought affordable alternatives to LA or the Bay Area. But now, with interest rates staying high and demand cooling, the market is beginning to show signs of strain and oversupply. One of the biggest concerns with Bakersfield is its economic vulnerability. The local job market relies heavily on oil, agriculture, and logistics, sectors prone to market volatility, regulation, and automation. As California shifts toward cleaner energy and automation replaces many warehouse and farm jobs, job growth in Bakersfield has slowed. With limited economic diversity and wage stagnation, many residents are struggling to keep up with rising living costs, putting downward pressure on home values. Environmental issues also weigh heavily on Bakersfield's housing outlook. The city has some of the worst air quality in the country, driven by surrounding oil fields, traffic, and geography that traps pollutants. Add to that rising summer temperatures and ongoing water shortages, and you have a less desirable, long-term destination for new residents. These factors can limit demand and increase maintenance costs, making homes harder to sell or hold profitably. Although Bakersfield's affordability once made it a hot market, in 2025, it's become clear that low prices don't guarantee high returns. With job insecurity, environmental challenges, and a cooling demand from investors and out-of-town buyers, the city is vulnerable to a housing price correction. Those considering buying here should do so with caution and with a long-term strategy in mind, because Bakersfield market may be entering a period of slow decline before any potential rebound. Number 7. Stockton. In 2025, Stockton stands out as one of the most at-risk cities in California's shifting housing market. Located in the Central Valley, Stockton saw an influx of buyers during the pandemic, especially those fleeing the high costs of the Bay Area. But what was once seen as an affordable alternative has now become a city with rising inventory, falling demand, and stagnant home values. As economic uncertainty grows, Stockton's housing market may be among the first to buckle. One of Stockton's biggest vulnerabilities is its economic fragility. The city's job market is largely based on sectors like warehousing, retail, and agriculture, industries that offer limited wage growth and are susceptible to automation and recession impacts. With few high-paying career opportunities and a growing cost of living, many residents are struggling to afford their mortgages. As affordability tightens, demand is slipping and price reductions are becoming more frequent. Public safety and infrastructure are also major concerns in Stockton. The city has long struggled with high crime rates, under-resourced schools, and a strained police force. These issues directly affect property values and buyer confidence, especially for families and long-term investors. When crime increases and schools decline, neighborhoods lose their appeal, causing a drop in both demand and long-term stability for homeowners. Despite its location within commuting distance of the Bay Area, Stockton hasn't seen the kind of sustained growth needed to stabilize its housing market. With economic headwinds, safety concerns, and reduced buyer interest, the city is poised for a market correction in 2025. While prices may look tempting on the surface, the risk of depreciation and poor return on investment makes Stockton one of the most fragile housing markets in California today. Number 6. San Bernardino. In 2025, San Bernardino remains one of the most vulnerable housing markets in California. While the city has long been known for its relatively low home prices compared to coastal areas, affordability has come at a cost. San Bernardino faces deep-rooted economic, social, and infrastructure challenges that make it a high-risk city for homebuyers and investors. With rising interest rates and inflation stretching household budgets, demand has started to fall, and prices may soon follow. One of the biggest red flags in San Bernardino is its limited economic diversity and high unemployment rate. The city has struggled for years to attract stable, high-paying industries, and much of the workforce is tied to logistics and service jobs, sectors vulnerable to economic downturns. With few new jobs and limited upward mobility, residents are less able to afford rising housing costs. This creates an environment where home values are likely to stall or even decline, especially in overbuilt or over-leveraged neighborhoods. Public safety remains a persistent issue. San Bernardino continues to rank high in crime rates statewide, and its infrastructure is outdated and underfunded. These issues drive away potential buyers and can depress home values, even in otherwise affordable areas. Schools, hospitals, and public services are under pressure, which affects overall quality of life. For families looking to settle down or investors hoping for appreciation, these realities make the market a risky long-term bet. In a time when many are seeking stable investments, San Bernardino offers affordability but not reliability. With a fragile economy, high crime, and wavering demand, the city is primed for a housing market correction in 2025. For those considering buying here, it's crucial to look beyond price and weigh the risks carefully. Because when the housing bubble deflates, San Bernardino could be one of the hardest-hit cities in California. Number 5. Vallejo. In 2025, Vallejo is increasingly being flagged as a high-risk housing market in California. Once considered a budget-friendly alternative for Bay Area commuters, Vallejo experienced a sharp price surge during the pandemic-era buying boom. But with that momentum now fading, the city faces mounting pressures that may soon lead to a serious housing correction. Buyers who once sought affordability here are now confronting economic, social, and infrastructure challenges that threaten property values. One of Vallejo's long-standing struggles is its underfunded city services and aging infrastructure. The city declared bankruptcy back in 2008 and, despite some recovery, has never fully regained its financial footing. Roads, schools, and public safety services remain inconsistent, affecting both livability and buyer confidence. As surrounding areas become more competitive or recover faster, Vallejo risks being left behind, with home values stagnating or sliding in response to lowered demand. While Vallejo once benefited from being a lower-cost option for Bay Area workers, the remote work trend that once drove buyers here is now reversing. More people are returning to urban cores or relocating to other states entirely, causing demand in outer-edge cities like Vallejo to drop. Public transit options like the Vallejo Ferry are no longer as enticing when people aren't commuting as often, and without strong local job growth, the city doesn't offer the economic backbone to support sustained price growth. With affordability fading and its appeal as a commuter hub in question, Vallejo's housing market is losing traction. Property values are starting to slip, and many investors are rethinking their position in this once promising city. While it still has potential due to location and natural beauty, the short-term outlook for Vallejo's housing market in 2025 is shaky. For buyers and investors, it's a city to approach with caution, as the next wave of California's housing correction may hit Vallejo harder than most. Number 4. Oakland. In 2025, Oakland is at a critical crossroads. Once a rising star in the Bay Area's housing market, the city is now showing clear signs of a correction. After years of rapid appreciation driven by spillover from San Francisco, prices are now retreating. Amid high mortgage rates, tech layoffs, and growing economic uncertainty, Oakland's median home price, which peaked during the pandemic boom, is now becoming unsustainable for local buyers, pushing the market toward a significant slowdown. Oakland's housing market is closely tied to the broader tech economy, and with continued downsizing in Silicon Valley, demand has weakened considerably. Remote work has led to an exodus from the Bay Area, and while some buyers look to Oakland for affordability, the city's crime rates, declining downtown activity, and uneven public services have made many reconsider. Condos and multifamily properties are particularly affected, with longer days on market and frequent price cuts becoming the new norm. Public safety and civic stability are also eroding buyer confidence. Oakland continues to face chronic issues with crime, homelessness, and budget constraints. These quality-of-life concerns weigh heavily on potential homeowners, especially families and long-term investors. Even in historically stable neighborhoods, rising theft and public disorder are prompting some residents to sell, driving up inventory and softening prices even further. Oakland still has potential in the long term due to its location and cultural vibrancy, but in the near future, the housing market outlook remains weak. Without a major economic turnaround or safety improvements, the city is likely to continue seeing depreciating home values and growing hesitancy from buyers. For anyone eyeing Oakland as a place to invest or settle down in 2025, caution is advised, because this market is no longer the sure bet it once was. Number 3. Los Angeles. In 2025, Los Angeles stands at the intersection of prestige and pressure. Long known for its global appeal, entertainment industry, and cultural diversity, LA has also become a symbol of California's housing crisis. After years of skyrocketing prices, the city's market is beginning to soften, and a larger correction could be on the horizon. With median home prices still well above $900,000, 0 cents, and affordability at an all-time low, many buyers are stepping away, and inventory is quietly starting to build. One of LA's biggest challenges is its severe affordability gap. Wages haven't kept pace with the cost of living, and even middle-class professionals find it nearly impossible to buy. High mortgage rates have only made this worse, pricing out many would-be buyers and leaving homes sitting on the market longer. Investors, too, are growing cautious, especially as rent control, maintenance costs, and vacancy rates in some neighborhoods start to eat into returns. As demand slows, price cuts are becoming more common, particularly in condos and luxury markets. Quality of life issues are also affecting market confidence. LA continues to struggle with homelessness, crime, and deteriorating infrastructure, especially in areas like downtown and South LA. These issues not only deter new buyers but also push longtime residents to relocate, either to cheaper inland areas or out of state entirely. As more people leave and fewer buyers enter, some neighborhoods could see sharp and uneven price declines, particularly where appreciation was speculative. While Los Angeles will always be a hub of culture and opportunity, the housing market in 2025 is shifting under the weight of its own excess. Without meaningful improvements in affordability, livability, and local governance, home values are at risk, especially in overheated or investor-heavy areas. For buyers and investors, this is a time to proceed with caution, because even in the City of Angels, the real estate halo is starting to dim. Number 2. San Francisco. In 2025, San Francisco, once the crown jewel of California real estate, is facing a sobering reality. Its housing market is in decline. After years of sky-high prices driven by the tech boom and global investment, the market is now reversing. The city has seen one of the steepest price drops in the state since the pandemic peak. With median home prices still hovering around $1,200,000 0 cents and affordability at historic lows, many buyers and investors are choosing to walk away. The downturn is tied closely to tech industry shifts and remote work. As companies downsize or relocate and employees opt for more affordable cities, San Francisco is experiencing a prolonged demand slump. Condo towers that once sold out in weeks are now filled with unsold units, and price reductions are becoming more frequent. With fewer buyers in the market and a growing inventory of high-cost homes, the city is now at risk of a deeper and more lasting housing correction. San Francisco is also grappling with serious quality-of-life issues that further dampen its housing outlook. Public safety concerns, a visible homelessness crisis, and empty downtown streets have shaken confidence in the city's recovery. Retail closures and declining foot traffic have hurt the vibrancy that once defined the city. As more residents leave for better managed and more affordable areas, home values are likely to continue slipping, especially in luxury and investor-heavy segments. Though San Francisco still holds immense cultural and economic value, 2025 is proving that no market is immune to correction. Unless affordability, public safety, and employment stability improve, the city may continue to see declining prices, and for some homeowners, substantial losses. For buyers and investors looking at San Francisco, it's no longer about timing the peak, it's about avoiding the drop. Number 1. Santa Barbara. Santa Barbara has long been seen as a jewel of California's Central Coast. Famous for its beaches, upscale charm, and Mediterranean climate, But in 2025, even this idyllic city isn't immune to the pressures of a shifting housing market, with median home prices well over $1,700,000, 0 cents. Santa Barbara has become one of the most expensive cities in the state, and while demand once seemed endless, that momentum is now slowing as fewer buyers are willing, or able, to pay such a steep premium. One of the biggest concerns in Santa Barbara is overvaluation. Prices skyrocketed during the pandemic, as wealthy remote workers and retirees competed for limited inventory. But as interest rates remain high and the broader economy cools, the pool of qualified buyers is shrinking fast. With so few full-time residents able to afford homes here, properties are sitting longer on the market. This mismatch between price and local income is creating a situation where a correction seems not only possible, but likely. Environmental and financial factors are also stacking up. Santa Barbara faces serious wildfire risks, rising home insurance premiums, and growing concerns over water scarcity. These elements drive up the true cost of ownership, making real estate less attractive, even for wealthy buyers. And as insurance companies pull out or raise rates, some properties may become uninsurable or simply unaffordable, adding further pressure to devalue certain parts of the market. In 2025, Santa Barbara still looks like paradise, but beneath the surface, the housing market is on unstable ground. Without a broader pool of buyers, and in the face of rising costs and climate challenges, this ultra-high-end market may be nearing its tipping point. For those thinking of investing here, now is the time to proceed with caution, because when luxury markets fall, they tend to fall hard. Conclusion. As we've seen, California's housing market is facing serious headwinds in 2025, and these 10 cities are standing on shaky ground. From economic instability and rising interest rates to crime, environmental risks, and an exodus of buyers, each location on this list is showing signs of a potential price correction or crash. While some markets were overheated during the pandemic, others are now grappling with structural challenges that make a rebound unlikely in the short term. Whether you're an investor, a homeowner, or a potential buyer, now is the time to stay informed and cautious. Housing markets are local, and while California remains one of the most desirable states to live in, not all cities offer the same stability. If you found this video helpful, be sure to like, subscribe, and hit that notification bell for more deep dives into real estate trends across the U.S. And let us know in the comments, which city do you think will see the biggest crash this year?